Investment in the real estate debt side is coming back, and terms are moving. The risk appetite is moving, but I think it's relatively gradual. As an investor, we're generally at the core end, and so we'd be financing deals which are in the core space relatively low risk, and we don't want to increase our LTVs all that much. But there is an increasing amount of competition out there. The traditional lenders are largely withdrawn from the market, and that void has been replaced by non-traditional lenders such as ourselves, but it's becoming a bit more of a crowded place, and obviously when that happens, when you've got more competition, terms do move and pricing moves, but we don't think that we're going to get dragged along with going far too high up the risk curve. I think the amount of debt coming back into the market is increasing, but I think we're a long way off before we reach the 2006-07 levels. And I mean, we all have short memories, but hopefully it's a long enough memory to make sure that we don't repeat the mistakes of 2006-07.
Is it now available pretty much in the UK and across Europe, continental Europe, for development? Is that a block on any of the things that you're doing finance, or is now really finance just a straightforward part of the deal?
I think you have to separate London from that story completely. I think that London is very efficient. I think the development cycle is pushed on, and you can see the cranes on the horizon. And I think that it's a very strong market where it's driven by equity. And I think that one of the slides maybe that we have, which is quite interesting, is when you look back to the comparison in 2007 to the market today. There's actually way more equity in the market today than there was in 2007. So I think we're slightly cushioned by that, and I think I totally agree about the debt side, that the debt side is getting more liquid, but it doesn't mean it's available for everybody everywhere, which is where we came from. So I think that if you look at other markets, the development cycle hasn't kicked off in most of the other continental capitals, mainly because the occupier demand really hasn't pushed through in the same way. And I think that again it goes back to our conversation about the occupier and driving the next phase of growth. And I think a lot of people will be looking at those cities that are going to be the drivers of the economy going forward, and people are looking at what's going to drive rents in Frankfurt, what's going to happen in Paris, and will Berlin be the next big market in terms of scale, cosmopolitan nature, new airport and everything else, but rents are still very low. So I think the development cycle will kick off in some of these cities, but it's certainly not a wholesale change.
Okay, good. Josh,
I think that if you look at debt provided in the UK, we've got some stats for 2006. There was about 80 billion of debt done in the UK in real estate that year. The lending was pretty concentrated in the lenders we remember. In 2014, it was half that sum. It was about 40 billion, and it was much more widely dispersed, albeit bankers can't help themselves, of course. So you can probably only see it growing from here. I think Johnny's right. It has been a much more equity-driven market, and people taking down deals all equity and then looking to refi or fi afterwards. And I think development financing in Southern Europe is very hard to get. And then thirdly, you don't have, no offence to the Irish, but you don't have Irish individuals, having £1 billion line of credit from Allied Irish to come and develop UK property. So I think this whole know your customer and who banks and financial organisations now lend to, that has markedly changed actually. So they're much more discriminating about the underlying borrower, which clearly favours, bigger organisations who have sort of undoubted credits and high quality teams of people deploying the capital and managing the capital.
I think it's very easy to compare property returns to bond returns, and you figure out it's a great gap, and it's a good investment motivation. On the other hand side, property returns are very much impacted also by taxation, property taxation. So what I see in addition to that as a pan-European investor, if you only look at the property returns, it's only half side of the medal, because let's take a Southern European market an example, which where your property return is being by half thanks to taxation and structures. I think the need for leverage becomes even more important to compensate that. So what we currently see, and I would have totally agreed with the statement of purely equity-driven investment in 2014, but I think in 2015 we're seeing more and more debt-driven investments as well, in order, let me say, to really provide for the return, which makes it interesting. So above 3 to 4 to 5%. And so I would think there is a strong shift also to that to the debt side.